Welcome to The Explainer. Today, we're unpacking a financial maneuver that is literally shaking the foundations of Wall Street and big tech valuations. We're looking at Alphabet's unprecedented $80 billion stock sale. This isn't just your standard corporate finance update. It's a massive, historic pivot that completely redefines what it actually costs to compete in the modern technology sector. Okay, let's dive right into this because, wow, the sheer scale of this number demands our attention. $80 billion. Alphabet, the parent company of Google, has launched an equity financing plan to raise exactly that amount of capital by selling newly issued shares of company stock. To put that into perspective, $80 billion is larger than the total market cap of hundreds of well-known established public companies. It's a staggering sum, and honestly, it immediately forces us to ask a very fundamental question about how big tech operates today. And here's the core mystery, right? Why does one of Earth's richest companies need to sell stock for cash? Traditionally, the whole beauty of the tech giant business model has been that they fund their own operations and expansions using their own massive profits. They generally don't need to sell new shares just to survive or grow. Actually, selling new stock is usually what early-stage startups do, definitely not trillion-dollar mega-cap corporations. So seeing Alphabet turn to the stock market to essentially ask for cash, well, it's highly unusual, and it signals a massive shift in their financial reality. To really highlight the contradiction here, just think about the staggering amount of cash they already bring in. Over the past 12 months alone, Alphabet generated $174 billion in operating cash flow. On top of that, they've raised over $85 billion through global debt issuances. I mean, they have a mountain of cash flowing in, and they clearly have the ability to borrow heavily. Yet management decided they needed to diversify their funding sources. They wanted to maintain a pristine balance sheet without taking on excessive corporate debt, because that comes with burdensome regular interest payments. So they turned to the equity markets. Section 1. Breaking down the deal, how Alphabet is raising $80 billion. Now, selling $80 billion worth of stock isn't as simple as just clicking sell on a trading app. Alphabet is executing this massive capital raise by splitting it into 3 distinct tranches. First up, there's a $10 billion private placement. Second, $30 billion in underwritten public offerings. And finally, the largest chunk, a $40 billion at-the-market or ATM program. This ATM program is absolutely crucial because it allows Alphabet to slowly drip-feed shares into the open stock market over an extended period. Instead of just dumping $40 billion of stock all at once, which would without a doubt crash the share price, they use broker-dealers to sell shares gradually at current market prices. What's really fascinating about these specific details are the players and the financial instruments involved. That $10 billion private placement, it was negotiated over a swift 24-hour period and anchored by none other than Berkshire Hathaway, taking $5 billion in Class A and $5 billion in Class C shares. Securing a massive, long-term institutional investor like Berkshire, even at a 6 to 8% discount, gives this whole deal massive institutional validation. Meanwhile, heavyweights like Goldman Sachs, JP Morgan Chase, and Morgan Stanley are managing the public offerings. And definitely take note of that $15 billion in mandatory convertible preferred stock. These are special shares that automatically convert into regular stock at a later date, basically acting as a structured bridge between debt and equity. But here's the catch. Anytime a company issues new shares, there is an immediate risk to the people who already own the stock. That risk is called shareholder dilution. Think of a company like a giant pizza. If you own one slice out of 8, you own a pretty good chunk of the pie. But if the company suddenly cuts that exact same pizza into 16 slices to sell more, your single slice just became half the size. By issuing $80 billion in new shares, Alphabet is reducing the ownership percentage and the earnings per share metrics for all existing stock owners. It's a bitter pill for Wall Street to swallow, so the reason for doing it has to be absolutely critical. Section 2. The physical cost of AI. Why the AI arms race demands cash. So we're pivoting now from the financial mechanics to the physical reality of why this capital is so desperately needed. Remember that massive 12-month operating cash flow we talked about? $174 billion? Well, compare that against Alphabet's newly revised projected capital spending for the year, a range of $180 billion to $190 billion. The projected costs to build what they need to build are now physically outpacing their massive internal cash generation. It's an intersection that totally forces their hand. They are literally spending money faster than their core search and advertising businesses can print it. And why the sudden spike in spending? Alphabet's CEO, Sundar Pichai, hit the nail on the head. He said, "Compute supply is our most urgent operational constraint." The demand for artificial intelligence solutions from everyday consumers and huge enterprise clients, specifically for their Gemini platform, is entirely outpacing the physical hardware available to actually process it all. Alphabet, along with hyperscale competitors like Microsoft, Amazon, and Meta, are all waking up to the fact that they simply don't have enough computers to do what the world is asking them to do. And to be clear, we aren't just talking about writing some new software code in the cloud. Artificial intelligence is incredibly heavy, expensive, and industrial. The capital from this massive stock sale is going directly into physical infrastructure. We're talking about buying huge amounts of specialized computer chips, tearing up the ground to construct physical data centers, acquiring massive swaths of real estate, and completely re-engineering connections just to tap into local power grids. Building AI requires raw materials, concrete, copper, and staggering amounts of electricity. It's the whole shebang. Section 3. The market ripple effect. The Wall Street fallout. Let's move along and see exactly how this impacts the broader macroeconomy. The launch of an unprecedented $80 billion stock sale triggers a very clear domino effect. Step 1. The stock market sees an immediate increase in the supply of Alphabet shares. Step 2. Investors instantly price in that near-term shareholder dilution we talked about earlier. Step 3, because of that dilution, Alphabet's stock price falls. And because it's such a massive company, it actually pulls down the broader NASDAQ and tech indexes right along with it. Finally, step 4, financial markets realize that if Alphabet's profits can't cover the AI race, neither can the others. Wall Street equity analysts are forced to completely recalibrate valuations across all major tech firms based on these suddenly higher capital costs. But it doesn't stop there. This massive capital extraction also starves the rest of the ecosystem. Tapping the stock market for such a historic sum leaves significantly less available investor capital to support other companies. Pure-play AI startups that were planning to enter the public stock markets through an IPO are now facing a much tougher environment. They suddenly find themselves competing directly with established giants like Alphabet for the exact same pool of investor cash. Talk about a tough break. Section 4. The new tech reality. A massive paradigm shift. So the crucial point here is that this $80 billion move isn't just some anomaly. It's a massive paradigm shift in how we understand the entire technology industry. It brilliantly illustrates the difference between two worlds. The old tech model, which defined the last 2 decades, was all about high-margin software. It was capital light, you write code once, and you sell it 1 billion times. It was super easily funded by internal profits. But look at the new tech model. The AI era requires heavy physical equipment. It is incredibly capital intensive. And as we've seen today, it requires massive external funding. Major investment firms are absolutely taking note, shifting cash away from legacy consumer brands and starting to treat these tech giants more like industrial utility companies. Which leaves us with this final, incredibly important question to ponder. What happens to all of this expensive infrastructure if consumer and enterprise AI adoption actually slows down? Building a physical data center takes years. This means the massive financial outlays are happening long before Alphabet can turn those facilities into measurable profits. If the AI boom falters, Alphabet and its competitors risk getting stuck with billions of dollars worth of expensive, underutilized infrastructure that could severely damage their long-term corporate profitability. They are basically betting $80 billion that this demand is permanent. The real question is, are they right? Thanks for joining me on this explainer. Keep a close eye on the markets because the rules of tech have officially changed.